Well, welcome, gentlemen. The first thing I want to point out as somebody from Auburn, Alabama, is that we're not talking about the more important SEC today. We're not talking about the athletic conference where football dominates. We're talking about the SEC that's a 5-minute walk from here. And there have been some changes lately, as you all know. Recent SEC activity and recent statements by Chairman Paul Atkins suggests that the SEC is scaling back Rule 14A8, no action review. For those in the audience unfamiliar with 14A8 review, it's the process by which public companies seek the SEC's blessing for excluding a shareholder proposal from its proxy statement without risking SEC enforcement. When a shareholder files a proposal with a firm, the firm has certain grounds for excluding the proposal from its proxy statement. For example, if it would violate state law, if it relates to a personal claim or grievance, if it concerns ordinary business purpose, et cetera. So here's some possible reasons why the SEC is scaling back this review. Its officials are possibly uncomfortable with companies relying on SEC no action letters as a form of regulatory cover for excluding proposals. They believe a more limited review process is more efficient and does not materially undermine shareholder democracy. They're shifting the risk of exclusion decisions to companies themselves, which may have contributed to an increase in shareholder litigation. And more broadly, they view this move as decentralizing shareholder engagement rather than having these issues resolved by the federal SEC, whose approach may shift from one administration to the next. They could expect more disputes to be addressed under state law, creating competition among jurisdictions in developing shareholder engagement rules and doctrines. So we're going to get into a little bit of the weeds, but before we do, because we have differing degrees of familiarity in this room and online with this shareholder engagement process, Jerry, I want to just start with you and ask you to explain this shareholder engagement process and sort of what you do on an annual basis and some successes that you've had this year.
Yeah, happy to. We haven't had any successes. The shareholders have. All we do is the paperwork. But I'm not sure which SEC is going to score more goals this year. Atkins is having a pretty good year for getting done what he wants to get done. So this 14A8, I mean, it sounds so technical, right? 14A8. What is that? Basically, it's the way corporate America was ideologically captured. I mean, if you look at what's happened in corporate America, if you see like, Tractor Supply and John Deere having pronoun mandates when they have a customer base that is completely out of line with that. When you see all these commitments to puberty blockers for the children of employees and oil and gas companies basically promising not to be oil and gas companies. 14A8 was the way that happened. And that's the way it tends to happen. I think the left is extremely good at using the administrative state and hacking the rules in secret, in sort of technical ways, in order to accomplish social change. They kind of do it, out of view. So I'm not a fan of it, but I use it every day of my life because those are the rules, and as long as those are the rules, we're going to play by those rules. I think that I'm going to critique it, then I'm going to defend it a little bit. The critique is that essentially it's eminent domain on the resources of public companies. Just because someone owns $2,000 worth, which might be a billionth of the market value of a large company, does not give them the right to a 3-minute speech that all the other shareholders have to listen to, or prime real estate on the proxy statement of a gigantic corporation because they want to go on about monkey slavery or something, or some crazy PETA type. And that's real, right? These kind of really extremist, political agenda items. On the other hand, the left did it for 30 years. And they did a long march through the institutions. And we are seeing the reverse march through the institutions right now in real time. And if the SEC comes along and says, game over, just when the game started to get reversed, that may seem neutral, but it's not. It's just like if there's a football game. I'm going to talk about the real football, okay? If there's a football game and someone gets to the 5-yard line, and then and they fumble, which ESG did, and then somebody else picks up the ball and they say, okay, let's go, and they get to the 10-yard line, and then all of a sudden the NFL says, game over, even though it's not really over, that's not neutral. So I think the SEC needs to find a way to accommodate the correction that's going on, and maybe do away with parts of 14A8 or take some time in deliberation thinking about the timing on this.
Well, Larry, on this, stepping back from the traditional 14A8 approaches, do you think this is primarily a procedural change, or does it represent a fundamental shift in the governance of shareholder engagement?
It would represent a fundamental shift. And just to take one step back, this is one plank of Paul Atkins' effort to make IPOs great again. On the trail over the past 18 or so months since he's been in office, he repeatedly emphasizes that the public capital markets have become very costly, overly regulated, subject to lots of litigation, and there's just substantial deterrence for private enterprises to go public and stay public. And so this is an important one of a dozen things that he's identified as creating problems. Because most entrepreneurs, many companies don't want to be in the political buzzsaw that Jerry talked about, right, left, top or bottom. They want to drive returns on investment. That's what most businesses want to do. And so Paul, has seized on something very important, and he wants to drive a lot of substantive change. And that would certainly happen in this context of this rule that 80 years ago, it was designed as a procedural thing to facilitate shareholder voice in an electronic, in a mail-based world, postal mail-based world, and it got carried away. And it's been highly politicized, and I think that deters a lot of companies from wanting to be and stay public. And I think Paul's own view, Atkins' own view, he's very agnostic ideologically. Left, right, or center. I don't think he's keeping track the way that Jerry described. He's a libertarian. He wants things decentralized. He doesn't want the federal government where it shouldn't be, and thinks it's time for the SEC to get out of this business. And so, to answer your question, Alan, if the SEC gets out of this business, this would substantially change the substance of corporate governance, the allocation of voice among executives, managers, boards and shareholders that Stefan referred to.
Jim, we're hearing already that companies are possibly relying less on SEC guidance and facing more litigation instead. Is replacing administrative review with private litigation a feature of the new approach or an unintended consequence? Proponents of a reduced SEC role argue that shareholders are fully capable of resolving these disputes through voting and litigation. Critics worry that uncertainty may chill participation. Your thoughts?
Yeah, I think it's more of an unintended consequence. In other words, I don't think when the chairman gave his major speech on this at Larry Center last fall, he was saying, I want more lawsuits. I mean, lawsuits are going to happen when there's a dispute, and there's no question that the no action process that the SE staff managed, lowered the risk of such lawsuits, because basically if the SEC said, we give it a green light, there wasn't going to be a lawsuit, and the companies, if the SEC said, we're not giving it a green light for you to take this proposal and knock it off your ballot, the companies weren't going to go against what the SEC staff recommended. So I mean, I don't think it's an intended consequence. I do think, however, that the move to make this a state question rather than a federal question is correct. I've argued that, before the SEC and comment letters before both houses of Congress for years now. It is longstanding, right? The SEC created the predecessor to Rule 14a8 back in 1942. And as Larry said, it was a very different world back then, but they did so based on a fundamental misconception that a shareholder has a right at an annual meeting to speak and ask management questions. That's not the case under Delaware law. I don't think it was the case under Delaware law then. I've been a director of multiple private companies. It's simply not the case that a shareholder can show up and commandeer the room. And so Jerry's critique, if you have $2,000 of stock, should you be able to get a big space on the proxy statement, I think is wrong. And the proxy statement, remember, is a disclosure, is part of the disclosure rules that the SEC is tasked with under the 33 and 34 Acts, the Securities Acts that oversee this process. But substantive state law is substantive corporate governance. Substantive corporate law still resides with the states overwhelmingly, has not been preempted by Congress. So we basically have a two-tiered system where disclosure is federal, substance is state. And even though Delaware has long dominated in corporate governance, something that's maybe changing a little bit now, the competition, or at least the threat of competition, for normal federalist reasons that we support, generally is efficient. I mean, this is a debate. William Carey was the chairman of the SEC, and in the early 70s, he wrote a big race to the bottom argument, arguing that the SEC should take over this field. And my mentor, the late, great Ralph Winter, for whom I clerked on the Second Circuit Court of Appeals, wrote the seminal corporate law article saying, no, just wait a minute. This is efficient, because if you're actually hurting shareholders with your rule and protecting managers with your rule under state corporate law, you're going to get a discount in terms of raising capital. So no one's going to want to take the company public in Delaware if, in fact, Delaware's doing that. And so this is the sort of interplay we have. I think it'll be messy in the short run. There will be lawsuits. But I think decentralizing this in the long run is better. And it doesn't mean there will be no opportunity for derivative litigation or shareholder proposals or things like this. But I do think it's the right rule legally, and I think it's the right rule in terms of policy. So I'm glad to see the chairman taking this step.
Yeah, thanks. Jerry, does the SEC's reduced role help depoliticize the shareholder engagement process? Does it take away a tool that conservatives were just starting to use? And is there a point at which shareholder engagement ceases to be engagement and becomes a form of private regulation of public companies?
Yeah, I'd say on the first, over the long run, yes. I think that 14A8 has been the source of a lot of politicization. And what is it, 20646 basically created the proxy advisory services. Also, unintended consequences. In government policy, you get a lot of unintended consequences, right? Raise the minimum wage, you cause unemployment, et cetera. The sheer number of unintended consequences that I see in proxy voting world, like Biden tries to open it up to more liberals and more conservatives go in, right? It's happening over and over again. I've seen some of that on the Trump side too, where try to choose sides a little bit, but it's kind of going the other way. So what I would say is, if you're talking about a real world impact now, if you shut it down now, you are shutting down the correction. No doubt about it. All the momentum. We were over there on like the 1 yard line, and they fumbled before corporate America was completely ideologically captured, and we're running with it, and all of a sudden, game over. That would be the effect. I know that. That's what we're doing all day, every day, 80 hours a week. We're winning. And if you shut down the system under which we're winning, conservatives didn't learn the rules because generally we don't do power very well. We caught up and we have some momentum. Over the long run, I think probably it's too easy to get on ballots, for sure. Maybe there shouldn't be any right to be on ballots. I think states can determine that. But I think there is a federal role, though, because here's the thing. The SEC is a federal agency, all right? If you're a company and you sell shares, and you don't just sell them in Delaware, then there ought to be some role that's not just Delaware in determining what you say to the public. And if you say we're a Delaware company, and so there are certain rules to get on the ballot, and then you don't follow even your state rules, then that's fraudulent. That's misleading information about the company. And I will note that last year, when the SEC said we're not going to enforce Rule 14A8, the way to get on ballots, except we will enforce, 14A8I1, which is the one that says, yeah, but if you're violating state law, we will adjudicate that. So I know this gets complicated. You can't just get on ballots just because you follow the 14A8 rules. That's what they said, because they're too busy, because there was a shutdown. But they carved out an exception. They said that we will weigh in if you violate state law, if you don't follow Delaware when it comes to what gets on the ballot. And it seems to me that if they don't regulate that, then why the heck is there an SEC? It's there to regulate fraud. So if a company says, we're in Delaware, these are our bylaws, and then they harass people who are actually doing proposals that are valid under state law, and the SEC says, we're not involved, then I'd say, why is there an SEC at all? Because that seems to be a core function in a national market for a Securities and Exchange Commission that was created by congressional action. It has statutory basis, in my opinion, on which to adjudicate that question. And if they did that, then the correction can continue, and we'll weed out a lot of junk shareholder engagement stuff that's been coming from the left.
Larry, you conducted 2 surveys recently. I want to get the titles right so that people can.
And by the
pull
way,
this.
and also from the right, you can get junk shareholder proposals from the right. I need to be clear.
Sure.
There's a lot. It's activist proposals that are the problem, not mainly left and right. It's just the left did most of them before. Sorry.
You're good, Jerry. Yeah, so these 2 surveys, Larry, one is titled Shareholder Proposal Survey Report and Analysis of Results. The other one is Deep Divides and Limited Consensus, a 2026 survey of law professors on shareholder proposals. So the first one surveyed shareholders, public company representatives, directors, and so forth. The second one is a survey of 89 U.S. corporate law professors. I want to ask you about these surveys and your findings. Did they suggest that the shareholder proposal system is functioning as intended? Has it drifted from its original purpose? If the SEC continues to play a smaller role in policing proposal exclusions, what reforms or principles are most important to preserve legitimacy and predictability in the system?
Yeah, thanks, Alan. So as Jim said, Chairman Atkins delivered a big speech at the center that I run in Delaware on October 9th, declaring, among other things, that the SEC is going to have a fresh look at this Rule 14a8 and expressing the view that these guys have just referred to, that these proposals may not even be valid under Delaware state corporation law. I mean, I'm in a room of 160 of Delaware's great and good, and the jaws were just on the floor. It was a stunning, stunning speech. Why? Well, because this is a federal invention that states have had virtually nothing to do with for 80 years. And people in Delaware, when they heard, and we do know that it's a very politically toxic rule and has produced a lot of difficulty and disagreement. And so the room full of Delawareans were like, okay, the federal government created this mess, and then they're going to hand it over to us. That's what's going to happen here. And so the room was stunned, and as I began to, I had a heads up. I asked the chairman when I invited him to come. I wanted him to give a substantive speech. And so that's what the Weinberg Center does. We weren't just having a party. We wanted to talk substance, and so I was delighted from my point of view for the substantive provocation. But as I talked to my Delaware friends over the next couple of weeks, I realized that there wasn't a lot of expertise on this topic. Delaware lawyers and judges are deeply expert in corporate law, fully fluent in business talk. But this topic had never really gotten on their radar screen. And so there have been a couple surveys that provided some useful information about this by the Business Roundtable, by Glass Lewis, from somewhat opposite ends of the perspective on this. So the Weinberg Center decided we should generate some knowledge. And so we conducted that first survey late in the year and into January. We had 520 respondents, as you said, Alan, shareholders, board members, managers, and we got all the groups involved. So we had the Business Roundtable, we had the Shareholder Rights Group, we had a lot of input, Chamber of Commerce, NAM, a lot of input, very diverse range of results. And so there was a lot of disagreement about the efficacy of the rule, whether it works well, whether it's efficient, whether it's desirable, whether it's too politicized, a lot of diverse views. I think it was pretty clear, though, Alan, to answer your question, that it has drifted significantly from its origins and intentions. There was substantial agreement that it's a useful device to enable shareholders to exercise voice around shareholder value, board accountability, executive compensation, takeover defenses, and majority voting, et cetera, stuff that has been part of the use of this thing for 80 years. But there was a lot more disagreement about its usefulness for carbon footprint reporting and counting demographic diversity in an organization or advocating for some of the things Jerry talked about around gender transition and stuff like that. So there's a lot of disagreement around, but we found a few points of consensus, and I think those are any reform, or if the states were to receive this, or if company, by that I mean if the federal government, if the SEC says we're not doing it anymore, we'd like to remove this rule, the states would have to participate in some way, at a minimum to say, you can have a bylaw that authorizes this. And then you might have some rules around that. So the state would have a role to play in saying what the valid rules are, what would be out of bounds. So the survey indicated that there are a bunch of attributes of the system that would be very desirable: predictability, clarity, consistency over time, and apolitical stability. So one upshot of the survey, Alan, was that I think this is consensus. There's always some tails, but basically, very few people are happy with the current system, and very few people have a better idea. There's not a lot of enthusiasm for the private ordering. Again, it's in the tails. So it's a frustrating situation. That learning enticed us to conduct a separate survey of the professors. We thought, okay, these are participants, and it's that you can expect that they will provide role perspectives, and so we might not get objective assessments of things. So we turned around and did a different poll, a normative poll of U.S. law professors in the corporate area. We got 89, N is 89. It's not as robust, but it's pretty good. The most interesting thing about that survey was that it reflected a wide variety of philosophies and viewpoints on this system, on this proposal process. So a lot of people think, oh, professors, they must always want lots of shareholder voice and lots of agitation. That's not the case. There's certainly a cohort that believes in an expansive role for shareholder proposals. There's another cohort who considers 14A unauthorized by the federal statutes and a usurpation of authority by the SEC and would rather see it abolished. There are others who strongly advocate a private ordering approach. So there's a lot. I was refreshingly surprised by the diversity of views among the academy. And that said, a couple of things that did stand out. Again, there are a couple tails, but most of the responses did say, an attractive shareholder proposal rule system would cabin the proposals to topics that are firm specific, that somehow relate to return on invested capital, that aren't about let's change how we think about gender, or let's change about how we think about carbon, or let's change that social, environmental aspect is, again, there are tails. Some professors think it is the function of the corporation to engage in all that stuff. But I think a consensus from the data was a need for firm specificity. Another thing that came out was that people, this academy, these people have learned from Ralph Winter. I mean, they kind of think that, well, having some competition, having some experimentation, may well be a good idea. They're not as averse to it as the participants seem to be. They're a little more willing to be experimental about it. But they also recognize that it would be completely uncharted territory. So it will be a mess for a while. Jim is right about that. Anyway, those are and so please, have a look at the survey. I think they have a lot of valuable information in it. We tried to be objective and neutral. We were criticized for not being objective and neutral, so it obviously hit a bone in some quarters, but I think we generated some knowledge, so you can get them on the website, on the Weinberg Center website.
Yeah, that's great. Thank you. Jim, it's sort of interesting to me that one thing that people on the left and right tend to agree with is that asset management firms wield an enormous amount of power. I mean, that's at the forefront of these conversations about housing policy that we hear, the new housing bill. How should fiduciary duties constrain the pursuit of non-financial factors, whether they're environmental, social, that may not clearly relate to shareholder value? Are sole fiduciary duty bills that are passing in different state legislatures, are they having an effect? Are they changing the behavior of asset management firms?
Asset management firms have shifted behavior on the margin. And significantly in some cases in recent years. They'd also shifted previously, right? When I first started studying this, 15 plus years ago, basically the big asset, putting aside like social investment funds that exist for various social purposes, and putting aside state and local government union pension funds that are often controlled by politicians or public employee labor unions, most asset managers, were going to be neutral. They were going to abstain. They were going to broadly support management. They weren't going to bite on all these sort of E&S questions. And around 2017, that started to shift. I mean, it started to shift at State Street and then BlackRock, both of which are the big fund families that control big chunks of the passive index market. They started leaning in on some of these left-leaning environmental and social proposals. Before that, though, a trend I picked up in an empirical study dating back to 2012, the proxy advisory firms, which are to some degree a creation of the state, initially in pension plans through the Department of Labor, later through the SEC, creating fiduciary expectations for how these institutional investors vote their shares, created a demand for how to handle this. And so we live in a situation now where these two proxy advisory firms, and for a long time, the big two have dominated this market, ISS and Glass Lewis. Currently, they're both foreign owned. One's owned by the German stock market. The other is owned by a private equity firm in Canada and its principal owner. And they, before the big institutional investors started leaning in on these environmental and social questions. And so we have it's a weird system. The voting system itself is weird. Most individual investors, like me, may own shares in individual companies, as I do, but it's not worth our while to try to go through all these ballots to vote our pittance, our little $2,000 blocks of stock. It's not going to affect the outcome. The same reason why voters are ignorant in general elections, and there's a lot of literature on that, applies perhaps even more so, because you have a patriotic duty to be informed and go out once every couple years, once every year if you're talking about municipal elections also, and cast a ballot. But to do it for a broad, diversified portfolio of companies you might be investing in and trying to figure out all these proxy statements, it's just not worth your time, right? So these institutional investors and the proxy advisory firms that govern the process for the smaller institutional investors, the big ones have their own teams to do these votes, dominate this sort of process. So we've seen that sort of shift over time, and it's something that I keep, sort of rattling the saber on. A couple years ago, I wrote a study talking about, what are we going to do about these big fund families? Because the big passive fund families, the big three or the big four, depending on how you count it, own an increasing share of the market, and the bulk of the capital for at least three of those fund families is passive. Passive indexing is great. I mean, John Bogle at Vanguard really helped Americans wanting to save for their investment. I've invested for years in Vanguard funds. And basically what you're doing is you take a snapshot of the market and you replicate the market. You don't have to worry about whether your fund manager is good or bad, or they might have turnover in who's managing the fund, because they're not actually doing anything except taking a snapshot. And then you allow the hedge funds and the actively managed funds, and there's still a fair number, to sort of price the market, and you just sort of invest your retirement and forget about it. But because these small number of fund families have gotten a larger and larger percentage of the share votes, they become increasingly powerful, and they become the kingmaker such that the big three control 25-ish, maybe 30% of the vote, and another 25% is implicitly de facto controlled by the big two proxy advisors. Well, you can see how this sort of plays out in practice, and you can see why activists that care about environmental and social issues wanted to leverage this process, long-standing process that the SEC set up to try to get their way. It's a form of backdoor regulation. I wrote a book in 2020 called The Unelected, talking about how unaccountable elites are governing America. Well, this is one way that you've got two foreign-owned proxy advisory firms and three fund families with big passive holdings effectively controlling majority votes at all of our big publicly traded corporations, and they can get things done without going through our bicameral Congress and having to convince the president and get a broad national consensus if they're successful in this. And this really started alerting me. When I started doing it, the risk was lower than it is now. And it's higher now because the share going into these big passive fund families has gone up, not down, since about 2010, and it's gone up significantly. So this is something that I think we need to think about, and as the president, I think his executive order was right on proxy advisory firms, and it also had a line in there about 14A8, which basically said, if you need to change or scrap 14A8 to fix this problem, you can do it. Wasn't really leaning in one or the other, leaving it up to Chairman Atkins and the SEC on this. But the proxy advisory firms are a piece of the puzzle. So are these big fund families. There's not an easy way to oversee this, but one way is through thinking about fiduciary duties. So I'm on the investor advisory committee to the SEC. Want to emphasize, I'm not speaking on their behalf. I'm speaking on my own. But organized a panel earlier this month at our IAC meeting and brought in different voices to think about these questions. Because if you're investing passively, why should you then feel presumed to engage actively such that you've got these big fund families that people basically, they don't give their money to them to try to influence corporations. They give their money to save for retirement in an easy, cheap, efficient way where they don't have to worry about it. And yet, then you've got these small teams of engagement managers at the asset management companies leaning in on corporate America. And for a while there, for about 2017 to 22, they were leaning in bad ways. That's how ExxonMobil got 3 dissident directors that were opposed to its business model elected. They got elected because the big asset management fund families and the proxy advisory firms went the wrong way on this. And little wonder that ExxonMobil just successfully reincorporated in Texas, where it's long been headquartered, out of New Jersey. And they're not adopting this now, but Texas has a number of rules in place, including thresholds on shareholder proposals and derivative litigation that in the future, a company like ExxonMobil could take advantage of if necessary. Because it's not the Jerry Bowyers of the world that are worried about Exxon. It's the left-wing agitators that are beating it up. And when you lose a director election to dissident, environmental, climate change obsessed directors and get them on your board of directors, that's going to wake up a company and say, well, maybe we need to change locations and protect ourselves.
And to be clear, they're not dissident directors in the classical sense. Like dissident directors want the business to do well, and they think management has made mistakes. They're not dissenting from management. They're dissenting from the industry. They're dissenting from the idea that there ought to be oil and gas companies. I'm still flabbergasted that the system got that broken that they were elected. And I think that was what also set the seeds for its own destruction. Because that's what the left always does. They overplay their hand. They go so far that eventually normies who are out of our weird little world of proxy engagement and proxy voting, which is a really highly specialized little kingdom with medieval rules that they're only 30 years old, but they feel like medieval rules. And to go in and say, wait a minute, something's going on, and kind of trace back to the beginning. And I think, kind of following up on some of the points that Jim made, if you're an asset manager, if you're an active asset manager, what's your skill set? Managing assets actively, right? I mean, just rearrange the words. It's in the name. All right. So you don't have the skill set of voting proxies. You ignore it. It's not on the CFA exam. It's not on the 65 exam. It's not in the 7 exam. You can get a PhD in finance and not have one credit unit on proxy voting. And then you go and you become a master of the universe and you're managing money. And then these things are coming in the mail and you don't know what to do with them. All right. So, and then what happens is the government rewrites the rules with 14A8, so now these proxies get stuffed with ideology, with climate change stuff, but it gets crazier. I wasn't joking before about when I mentioned monkey slavery. I've seen proposals from animal rights groups. Someone reads some crazy article and says, oh, somebody is shipping chimpanzees into the United States to work as slaves in factories, and we want a complete report on something we read, in some tabloid newspaper. That stuff is gumming up proxy statements. And so what do the companies do? They probably would like to ignore it, but the SEC says you can't really ignore it. You have to vote for it. Oh, and by the way, you also have to have rationale for why you voted against the monkey slavery thing, and you have to keep detailed records on that. And the companies say, I don't know how to do that. And ISS and Glass Lewis come out and they say, we'll handle all that for you. We are now 3 steps removed from any actual investor. No investor knows what's being done with those votes. So the agency risk, like the separation from skin in the game investors, means that they basically get ideologically captured, what we've seen. So to be an active asset manager, you're good at managing assets, not at voting proxies. Let's say you're BlackRock or Vanguard. The skill set is not really active management for the most part. It is, you're not trying to beat the market, you are the market. So what's your skill set? Getting costs down to almost zero by scaling. So really, Larry Fink's genius is building scale, not managing money. And so that's your skill set. Again, your skill set is not voting proxies. So we have a system where the people who have all the votes don't know how to do it. I mean, they're trying and everything, and so they give it to people who don't have skin in the game, proxy advisory services. That is a broken system. Now, we're all working within it, and we're actually doing pretty well right now, but going back to the root, you need a system that goes back to basics. What's the basic? Somebody worked their whole life to put money in a 401k. They need to know what the heck is going on, and they need to be in control of what the heck is going on. Anything else is a false fix. How we get there, it's complicated, but that's where we have to be going back to the first principle. What's the first principle? Property rights. It's in the Declaration of Independence. It's in the 10 Commandments. We need to get that power back to somebody who actually has something at stake. The accumulated savings, the saved up labor of their life should be under their control, not given to a giant aggregator who then gives it to a proxy advisory service, who then gives it to these committees where you have expert input, but they won't tell us who the experts are, and then out comes basically ESG and DEI voting. We got to fix that system,
and it's
fixable.
I think fixes have been trickling in. Yeah. I mean, these concerns have been pressed for several years now, and those big three asset managers got the message. BlackRock, Vanguard, and State Street have all begun efforts to pass the vote through back to the beneficial owners, right? Instead of having the voting decisions made by a group of 12 at the top of those firms, passing the vote through to the ultimate owners. Exxon has done this in the most spectacular fashion at the company level. It's decided that it's going to create a system where retail voters, individual people who like Jim who own like $2,000 worth of shares, or I own more than that. Instead of, I'm going to have more voice, those people are going to have more voice at Exxon because they'll be able to direct that their shares be voted the way management recommends it, whatever the proxy advisors, wherever the asset managers might otherwise think. I found this to be an ingenious breakthrough in this struggle that's been going on for years.
Except if you disagree with management, right? I'm all for what
you
Exxon
can always
did.
repeal it. You can always opt out.
Right, you can opt out, and then you can go to BlackRock, Vanguard, or State Street and get what? If it's not agreeing with management, it's different flavors of pro-ESG vote.
I think then you can cast your vote, independently.
Totally impractical.
Therein lies the for institutional investors outsourcing, you can do true pass-through voting. For retail investors, small investors, it's voter choice. And the problem with voter choice is you can default to management under voter choice programs generally, but otherwise, they basically, what do? They let you follow either their in-house team, so you vote, give us your vote the way we've always been doing it, or here's 3 options from ISS and here's 3 from Glass Lewis. Now, Jerry's made some inroads here, and listen, if instead of ISS and Glass Lewis, all these institutional investors were giving the decision to Jerry, I'd be fine with that. I still think there's problems structurally, because I don't think Jerry should control a quarter of the vote. But I think I would agree with Jerry controlling a quarter of the vote, because I think he would do it right. But there is an underlying problem here. And so, the pass-through is a good innovation. I've argued that we should have a mirror voting, where basically, if you're an index fund, it's only a piece of the puzzle. But if you're an index fund, if you follow the market, you should just follow the other shareholders and just mirror their vote. This could be done. It is done in some cases. It's not commonly done. The passives don't want to give up this power. There's complications on it. We discussed a lot of them at my hearing earlier this month. But
what is your preferred solution? I mean, so this sounds like what I got from my survey was, I'm very unhappy with this system, and I can't think of a better one. It sounds like we got the same thing with voting itself.
Well, I think mirror voting for the index funds is the right solution. It's not going to fix the proxy advisor problem. I do think the proxy advisor problem, and I'm hopeful that the proxy advisor problem is one that could get better. I mean, right now there are barriers to entry. Why is it a duopoly? There's barriers to entry because it's a big, complex thing to vote thousands of proxy ballots all around the world. It's not just American companies. And so it's not easy to do, and there's not a lot of money in the game. I mean, when ISS was owned by MSCI, we know they had 120 million in annual revenues, only 2/3 of which was from their proxy advisory side of their business. So that's 80 million in revenue. You're not going to get a bunch of venture capital to capture that unless they just want to have the influence, which is why I think they keep getting rebought and overpaid for.
So what's the solution?
Well, I think AI is going to lower the barriers to entry here. JP Morgan Chase this January, it said we're not going to use proxy advisory anymore. We're going to do it in-house. Now, JP Morgan has economies of scale that smaller institutional investors don't, but I do think there could be a more competitive market. And I was being a little flippant by saying give money to Jerry, but no, I mean I think people like Jerry will be able to compete in this market more effectively than they have traditionally, given the technological tools that are going to develop. So it may be a thing where the market helps do a workaround here, where the problem with the proxy advisory firms isn't their existence, it's that there's only 2 of them and they're so easily captured.
Well, there's a tiny third one, Egan-Jones, right?
Egan-Jones, I think they do a better job. Sean
bigger.
Egan does but they have a much smaller share, and they have for a long time.
Yeah. Very much smaller.
It's 3%. Yeah, I mean, it's been.
Well, I love the back and forth, and I want to keep it going. I actually deliberately want to disrupt organizational and structural harmony here by asking a question to all 3 of you and forcing you to muscle it out. Which one of you wants to answer it first? Because we've seen declining support for many ESG-related shareholder proposals. Asset managers scaling back public ESG commitments, companies talking less about ESG. On the other hand, many investors continue to focus on climate risk, human capital, and governance issues. So is ESG actually in retreat, or is it simply evolving under another label? To put it another way, how much of the apparent ESG retreat is substantive and how much is rebranding?
Can I start with that and then let these guys muscle it out? Look, this ESG is one chapter in a 100-year saga of a struggle about the soul of the corporation. Stefan asked the question first, is the purpose of the corporation to deliver shareholder value or to have a more stakeholder perspective? This is the debate that's going on for a century, and it goes in cycles and waves. And there's a decade or 15 years where we're primarily focused on return on investment, and then there's some social responsibility movement. It's been called different things. It was called managerialism in the 50s. It was Naderism with Ralph Nader in the 70s. It was corporate social responsibilities in the 90s. It's ESG from the aughts until the last couple of years. So it's in endless cycles, and it's accretive. So there's more of that social responsibility every time we go through the cycle. And so my answer to your question, Alan, is it's in retreat, but it's not. It's only hibernating. It's going to return. I think Chairman Atkins is going to not going to put nails in the coffin, but he's going to reduce the capacity to sustain this movement very substantially. Just a couple weeks ago, the SEC put out a proposal to rescind its climate disclosure rule that had been put in 3 years ago by Gary Gensler, his predecessor in the Biden administration. Very controversial rule, very extensive regulation of carbon emissions disclosure and effects that the company has on the environment, and just very extensive disclosure. I led a group of people that argued that this was beyond the SEC's authority to pursue, and Chairman Atkins and the agency just last month put out a proposal to rescind that, and I'm pretty sure it'll be rescinded. We'll have a nice notice and comment period. We'll have a big discussion around it. We'll see a lot of people. We already see in the comment period a lot of people saying, "Oh no, this E is a very environmental. It's a very big important part of ROI." But I think you're going to also see conservative voices or pragmatic voices emphasizing that is not the case. And so this will be, I think, a decent test of whether it's gone or just in remission. But I think his leadership, what's happening at the SEC right now, will go a long way to mitigate some of the exuberance.
Yeah. I mean, I agree with Larry. It's in retreat. A lot of that's due to administration shift. A lot of that is due to the left overplaying its hand. A lot of that is due to the efforts of people like you and Jerry that are actively pushing in the other direction on a lot of these questions. So it is in retreat. I filed an extensive comment paper last time when they made that rule, and I'll file a comment letter on the rescission that's being proposed right now. And I argued that it was a problem in the Wall Street Journal then, and it's going to be rescinded, and it will be upheld. The rescission will be upheld, but it doesn't mean it's not going to come back, right? Because Republicans aren't going to be in charge, or people that have a pro-market orientation like Paul Atkins aren't going to be in charge of the SEC indefinitely. At the end of the last Trump administration, we saw rulemaking on shareholder proposals, way more modest than I wanted, but we saw it. We saw it on proxy advisory firms, way more modest than I wanted, and the statutory hook courts have now thrown out, so they're going to have to rethink that in response to the EO. And we saw at the Department of Labor real fiduciary standards getting rid of some of the environmental and social overlays being introduced in terms of what your pension plan can be invested in if you're in a private pension plan. All these things were done. All these things were reversed as soon as the administration shifted. So yeah, I think it's not dead for good, which is why I think thinking about the rules of the game and the system really, really matter. And when you look at this notion of shaking up the way it's done, I mean, Jerry's absolutely right. I mean, you got to follow state law, and state law is going to be, it's going to be messier, but state law. There'll be a little bit of a back and forth and a fight over it. I mean, when Exxon reincorporated in Texas, they said, we're not going to take a 3% threshold at this time to get a shareholder proposal on our ballot. It's allowed under the new Texas incorporation statute under 2337. It's not something that I think a lot of companies will opt into in the short term. I think particularly with these big passive investment funds and the proxy advisory firms controlling so much of the vote, they're not going to win if they try to get shareholders to approve it. I do think a company like Exxon might reach a point where they say, screw it, we're going to do it. And they might be able to marshal support for it, in part because they have retail investors' proxies on a lot of those cases. And so if they're pushed enough, they might. But Exxon is a bit of an outlier case. I mean, they had bad dissident directors. I agree. We want shareholder activism. Partly what you want to make sure you do with these rules is not overly empower management. And that's something Republican leaders have got to think about, because you don't want folks that are investing in the market and thinking about how companies are being mismanaged to be neutered and unable to put pressure on boards to increase their return on investment for investors. So I think where we will see some significant impact aside from those edge cases in the near term is I think you'll see it in the IPO markets. I think if companies want to IPO in Texas and have a very high threshold for derivative litigation and a very high threshold for shareholder proposals, I think you'll see that happen. It'll be interesting. You'll be able to look and see if there's a discount or a premium on the pricing of the IPO. So we'll know empirically in some time what that looks like. And I think the chairman's view is very IPO centric. It's very much trying to get more public companies out there. So it's an experiment that we'll be able to see tested in the market in real time.
Yeah, but we got to switch to audience questions, Jerry. I'm sorry, you don't get to say your piece here, but I know you get to take the first question. How about that? Audience question.
If it's a good one.
If it's a good one, yeah, that's right.
So call on Bill Wichterman. He'll have a good one.
I want to stand. Thank you. Great conversation. You guys are so articulate and very thoughtful. I liked how you did the forest, not just the trees. I appreciate that. So you started on addressing this question of where, let me ask you all to do a little crystal balling. Regardless of whether it's a Republican or a Democratic administration that follows and it's elected in 2028, where do you predict we're going to be in this whole shareholder question 5 years from now? The reason I ask that is it seems to me like there were many corporations that were pushed into places they didn't want to be, and they just needed an excuse to get out of the corner where they were backed into. So I'm thinking that even with another subsequent Democratic administration, it won't just snap back to the Biden years. But I'd love to hear your thoughts on that.
I don't think we're ever going back because we're awake now, right? And we just slept through the takeover of corporate America by shareholder activists who basically harassed and cajoled them to take one side in a culture war based on the idea that the future inevitability will be wokeism. And they found out that there's a snapback. We didn't know what was going on. Now we know. We're never going to forget. We know the rules. We've got our own institutions now. Heritage Foundation is not going to say, oh, we're going to forget about proxy. I don't want to speak for you, but Heritage is like super involved. They're not going to forget and say, we're not going to fight this anymore, right? The red states are awake. They're not going to say, oh, it's okay now. We passed a couple of laws. They're going to keep on top of it. Careers are being built on fighting ESG. You're seeing state auditors become state treasurers, become members of Congress. So we're now, that's a guarded space. We're not going to go back. So I think where we end up is, and now that we're aware of it, it's going to be like the rest of American politics, I'm afraid. I don't think there's going to be a real solution for it. But there's the real solution of American politics. We kind of go back and forth. And I think corporate politics are going to go back and forth. But we have one huge advantage. Our ideas are sane. And we actually want the companies to win, right? So if for so long, how many proposals I saw that said to oil and gas companies, can you please tell us the risk of being an oil and gas company? Because that's what it amounts to. What are the risks of emitting carbon? Now, if you're an oil and gas company, there's no way to get energy out of hydrocarbons unless you break them apart and release energy and carbon dioxide comes out. There's no other way to do it. That's the chemistry of the universe. Physics and chemistry win in the end, over and over again. What's the risk of carbon emission? What's the risk of this? What's the risk of stranded assets? And until a guy we work with named David Bahnsen came forward with a proposal that said, what is the risk of not being an oil and gas company? We want to report on that. And he did that with Exxon. That all of a sudden, everything shifts. And Exxon, I'm not saying they did it because of that proposal, but I think there was a little encouragement. Real shareholder, a real investor, not someone who borrows $2,000 worth in order to go and game the system, or some fund that says, we do proposals, but we don't invest in these oil and gas companies for return. So they're not investing for return. So they're already admitting it's non-fiduciary. And what happened is that shifted. So we're in the game now, and we're not going to get out of the game. I think it's just going to become another contested space in American life until one side wins, and I'm not sure that one side ever wins in this. And I'm content with that. I'm content with, just like our politics, we go back and forth, and if one side goes too far, then the other side, then the people kind of go in the other direction. That's what I think 5 years from now looks like.
You go ahead. I just have two thoughts. One, just looking in that 5-year crystal ball, one thing I fear and one thing I hope for. The one thing I fear is that as we change the system and eliminate the federal shareholder proposal rule and make it happen to the states and have bylaw amendments, the activists are going to find other tools to advance their agenda. And some of those tools are going to start to target individual directors in director elections. And that's going to be very unattractive for corporate America. ROI is going to be even less important than ever. I don't know exactly where ROI will stand, but turning corporate ballots into political elections or having individuals race for those seats is going to be very bad for companies, very, very bad for the system. The concept of a board of directors is a collaborative entity. No individual director has any power to do anything. It's all as a body. So if the activists start to put targets on the backs of individual directors and you have directors running for office, that's not going to be good for corporate America. So that's my sort of dystopian fear of this. The utopian version, it's like, oh, it's Ralph Winter. It's like, oh, let's have states figure this out. This is what Paul Atkins believes too. Let's have my friends in Delaware create a statute right after the SEC repeals this to say, a corporation is entitled to have a bylaw that provides as follows. Shareholders have access, are allowed to put in these proposals and aren't allowed to put in these proposals, or they have to own a minimum percentage or or dollar amount or for duration, and companies figure out which of the statutory offerings are most appealing. And certain companies stay in Delaware, others move to Texas, and maybe it all works out, and maybe that competition generates an equilibrium or some other sort of bimodal distribution, and that might work out. So I don't know what's going to happen, but it is going to be significant change.
I mean, we've already seen directors running for office on this to some degree, but far less than the dystopian view. But we've seen this being leaned in on. I mean, the New York City comptroller had a big project, and he was basically scoring companies on, the race, sex orientation, gender identity, et cetera, factors. And until last winter, ISS leaned into this and said, we're going to vote against directors unless you hit certain diversity criteria. Glass Lewis still does this, right? So this is nothing new. I do think that the substantive rules matter, right? I mean, for things like DEI, the HR offices and the general counsel's offices matter probably more. And the stuff that's happening now on DEI, on discrimination that's going on in the Justice Department is going to have a big impact. It will reverse when there's an administrative change. But the Supreme Court won't reverse unless it gets packed and they change the doctrine. So I do think, some of this stuff's going to be hard to go back to full-throated to the way it was done, but it's going to be trickier if you don't have a federal enforcer. When it comes to the corporate side stuff, though, I mean, listen, the ESG was kind of a brilliant nomenclature that the UN thought up, 20 years ago. And, the G stuff matters, right? How often you elect the directors and how you elect the directors, that really, really matters, right? It's the E and the S stuff that's a problem. And it doesn't mean that environmental and social issues aren't material to the bottom line. It just means, as Jerry would say, a lot of their ideas hurt the bottom line. And, the question is, who do we entrust with that responsibility? When Stefan was saying, who's in charge of the corporation? And this is a debate that goes back to the beginning of corporate law and federal securities law. But, the traditional answer has been the board of directors is in charge with a fiduciary duty to ROI for the shareholder, right? And that is the corporate law rule. It's not an easy rule to enforce for a variety of reasons. Judges aren't going to try to second guess boards in most cases. But that's a pretty good rule. And then the shareholders are a backstop with that. In our publicly traded market, as long as you've got disclosure, the main backstop is pricing, right? Buying and selling the shares. The second order backstop is activist investing of the sort Jerry was alluding to, where an investor can take out a big chunk and say, no, we want to get new directors on the board. You're mismanaging this company. We need to break it up. We need to take it in a new direction. We need new leadership. And that's the second order backstop, right? If you're in a publicly traded corporation, you've got more backstops because of that than you do in a private corporation, for instance. And yet a lot of companies don't want to go public, and they don't because they don't want the plaintiffs' lawyers and these ENS left-wing activists to harass them. Is a big part of that puzzle.
I agree that we're going to see a shift towards directors, which means we need braver directors.
Yeah.
So that's where we go. That's where this movement needs to go, is to get people in boards who actually have the spine to be on boards. And I don't like the fact that directors are going to get harassed, but I'm not completely opposed to a natural selection system where cowards know in advance that they're going to get hammered if they're on the board, and therefore they don't go on boards. I think I saw a study that said 67% of members of the board of directors of corporations were Republicans. So, sorry, when I look at what happened to corporate America, I see a courage gap.
Yeah.
And just one other thing I want to say about your question, Bill, which is a good one. Where are we 5 years from now? A lot better than we are now, because we have so much further to go. All right, so Catholic University of America is here. They have Catholic guidelines coming out. I don't know if you noticed, there's a lot of Catholics in America. And right now, they're voting anti-Catholic because proxy advisory services have put out proxy guidelines that they say Catholic, but they're really Episcopalian. It's really been driven by it's a mainline church, kind of thing. The blue states have been voting in accordance with their ideology. The red states have been doing the same. They've been voting in accordance with the blue states' ideology. They're waking up. 1792 Exchange has been doing reports on that, and we're seeing red states every day waking up and saying, wait a minute, we are a permanent fund. We are funded completely. Let's say you have these permanent funds, which are funded by oil and gas revenues. And they're looking, and they're voting against oil and gas. They have one job, collect oil and gas revenues and give it away, and they're voting against oil and gas. They're waking up, but it's early, right? Out of maybe 26 kind of red states, there's maybe 5 or 6 that are on top of this. Heritage Foundation is on top of this, but there's a whole lot of other conservative institutions, like almost all the rest, that are not. So the gain possibility is huge. This is really early innings for us. So when we get to that 50-50 over the next 5 years, there's a lot of wins on the way to that 50-50.
Well, let's get another question, and then I'm going to limit your answers to 1 minute, and then I'll hit my shot collar.
I feel kind of looked at right now with that.
Me too.
We've got a question up here. Yeah.
Can I stand up? Okay. Thank you, guys. My name is Shadari Rono. I work with the TIS Foundation. A lot of the issues that I also want to thank you guys for being here. I learned a lot from this conversation. A lot of the issue with proxy voting is coming to the kind of where I see the propaganda that is coming from capitalism. As we know, America is the strongest foothold of capitalism. It breeds innovation, it breeds competition, and it breeds economic landscape for the United States and all their countries. I fear it's not a loaded question. How can corporations and even some social investments not lose the soul of their entities and enterprises without bowing to pressure of the propaganda of anti-capitalism? Because that's the root of all this vote buying, all this proxy voting, is the hatred and the poisonous venom of how anti-capitalism is. So I would love to hear your thoughts. Thank you again.
Yeah, 1 minute each, flipping the hourglass.
Well, I mean, my bulwark is state corporation law, as Jim explained. Delaware, Texas, all the states are capitalist. And so directors' duties run to shareholders to drive sustained returns on invested capital. It's a very capitalistic conception. And, I live in New York, and so I see a lot of that craziness, and it's really hard to take. It has not infected the business courts of the United States yet, hasn't affected Delaware. That's not the reason why companies are fleeing. I think that's an imperative that we need to sustain and really emphasize.
Yeah, I hear a more fundamental question that public opinion, education, and this is why we started the Adam Smith Society at the Manhattan Institute to get into business schools, because our board members were saying, we're getting these MBAs and they hate capitalism. That's a big thing to fix. It requires education reform. Heritage does this. We do it at Manhattan Institute. We need directors with spines. We need university trustees with spines. Myself, Ilya Shapiro, Chris Rufo, Andy Smerek, we've got a number of university trustees among our MI team. But too often Republican governors or whoever's doing the appointments will pick their big donors who may not have the same spine. So but it's a long-term process, and that's going to take a while.
Yeah, so your question is, how can companies resist? I can tell you basically our message to companies, and we had 140 meetings with companies in the past year. Simple message: grow a spine, we'll have your back. That's it. Larry Fink was on Brett Baer's show at Fox about a month ago, and he said we had the pendulum that went way over to the left. I was glad to see him acknowledge that. And now we have the pendulum going in the other direction. And so we're having the debate about the pendulum, where the pendulum should be. Totally wrong question. The problem is that we're thinking of it as a pendulum. It's not. Fiduciary obligation is a sacred obligation enshrined in thousands of years of law. It's in the Constitution. It's in the Declaration of Independence. It's in the Torah. It's in the New Testament. It is not negotiable. It comes from the biblical tradition. It is not just a moral, it's, in my opinion, a theological obligation. Basically, board members, you've got one job. That's it. And the more we focus them on that, but also have their back, because I'm going to give them a little credit or a little leeway. The other side showed up for 30 years, and conservatives basically were a cheap date for management. Just like, it's corporations, it's a bowling alley, it'll be okay, right? It's safe. They're on our side automatically, right? And we didn't show up, and then things got out of whack. But what I find is when we show up, they are often willing to stand up if they know that somebody's on the other side is counter pressure, because they really did get into this business to do business. Yep. And this stuff is a distraction, and we help them, okay, let's get the distraction out of the way and go, I see it right there, back to business, refocusing corporations on ROI.
Right. Well, gentlemen, thank you for the robust and insightful conversation. Everybody, that concludes our program. Please enjoy refreshments. Thank you very much.
Thank you. Nice job.